And because of the development of the master plan that I'm talking about, the neighborhood is also LEED certified. So this is the first in Italy. So for anyone or any tenants that look for future proofing themselves to make sure that they are well covered on all the ESG requirement and all those things, they will look for buildings like us.
Welcome to the Financial Coconut Podcast. I'm your host, Reggie, aka your Chief Financial Coconut, and this is a special series called Be Retired in collaboration with REITs and SGX. And I'm joined with Anthony. Anthony, for our audience that don't know you for some reason.
Hi, I'm Anthony. We are going to do a lot more of investing related content on TFC in the coming months. So we are revamping Stock Geek Out to be broader. We'll talk a lot more and have a lot more good juices about the investing landscape in general. And hopefully we can all retire, right? So, please do keep a lookout for that. If there's any content you want us to create, any people you want us to reach out to, feel free to drop in the comments below.
Nice. And we are joined with Lendlease Commercial REIT CEO, Kelvin. You want to introduce yourself?
Basically, I'm Kelvin.
Basically, yes.
Yeah, I'm the CEO of the REIT. The REIT has been listed for about 5 years. I think the coming October will be our 5th year. So we have do a lot to sort of like communicate with the audience, and happy that we are being asked to join this platform so that we can actually touch base with a different audience that you guys have, and hopefully we can share enough to provide that insight to the people around here.
But for audience that don't know enough about your portfolio, your REIT, right? Can you kind of walk us through what is your ideology, your mandate, all those stuff? Yeah.
Good one. I think what we are actually having is that we have a portfolio of around 2 Singapore assets, which make up around 88% of our overall portfolios, and we have another 3 office buildings in Milan. Of course, we started off with only 2, but after the first or second years, then we feel that we actually sort of want to beef our portfolio up so that in that case, the whole cash flow is more stable and we can provide that kind of stabilities on our distribution. So we acquired JEM 2 years after our listing. And the acquisition actually done through several phases, because we don't actually acquire in totality, but we break into three stages. I think in the initial stage, we acquired just probably less than 5%. That is to let the unit holders feel that how the asset is performing, whether is it a good asset that we should sort of further expand ourselves. So and in fact, we have a lot of support from the institutional investor that they feel that this asset seems to be a good one, because we have asset on Orchard Road, and during then I think it's good. There's a lot of tourists, but it doesn't actually have a good focus on the suburban sector itself. So in that case, we decided to actually go for the next stage, is to expand ourselves we acquire another 30%, so we make up around 35%. So we are the single largest investor on the whole integrated development itself. We are largest, so in that case, that is to position ourselves to further acquire any of the stakes from the other investors, so that in that case, they know that we will dominate the whole asset anyway. So slowly we negotiate with them, and at the last phase, we decided to take on all of the balance stakes. It's in stages, but it's well planned, so that in that case, we could sort of take over in a way that both the seller and the buyers are happy with the outcomes.
Actually, I'm quite curious, right? Because we have been speaking to a few of the REIT CEOs and leaders, and that seems to be a bit of a recurring theme. We get a bit of exposure first, we try it out, and then we buy more, right? Is that actually important, either to shareholders or even for your own management and understanding of the asset?
Actually, it depends on the asset that you are looking at. If let's say you are talking about maybe an industrial asset which only costs you around 50 billion or maybe even 20 or 30 million, you don't need to do this stuff.
Because the size alone is already like a taster. It's an appetizer, right?
It's quite
so small.
easy. You can do it in one bite. But for us is that if you look at commercial asset, it's sizable. JEM itself is worth 2.1 billion. In fact, when we acquired JEM, it's actually make a lot of history. I think in terms of like the asset size that we acquired, we grow from 1.4 billion to 3.6 billion. The growth is around 2.7 times. This is the history that we have created. No one ever do that. Of course, that is beside any kind of merger and acquisition activities. But purely acquisition-wise, this is the biggest so far in the SGX history. I think the other thing is that the growth of the capital size that we are talking about. I think when we get listed, we only have around 0.6 or 0.7 billion of equities capitals. But once we acquire JEM, I think it grows to around 1.6, 1.7. So again, this is the history. No one actually acquired bigger than the initial size that they have.
I mean, you more than double overnight.
More than double overnight. So these are things that we do. And also in terms of the total fundraising that we have, including debt and other kind of instruments, I mean, during the few years over that we are doing.
And I guess because it was done a bit step by step, you don't really have that indigestion with the acquisition.
Exactly. That's
Right.
true.
Yeah.
That's true.
But since it has become your biggest asset, the kind of leasing capacity is pretty well done. You know, you kind of like pretty much maxed out quite a bit on that front, right? And of course, 313 is also quite an interesting asset, right? But overall, the story is a bit messy in my view, right? You have a suburban mall with a office, you know, that is your biggest asset. Then you have the CBD mall, you know, which is also a big asset, and then you have the Milan. You know? So it's like from an investor standpoint, it's like what are these people
It's not
doing?
London,
Right?
Japan, Australia. It's
Milan.
Milan.
It's like,
Yeah,
okay,
Milan.
what is this? Right? So help me understand, like, where are we on this strategy? How are you thinking of managing this REIT?
Actually, it's a very interesting kind of questions. Why not I start with the whole strategy of why actually we go with this type of portfolios. Actually, I joined the first industrial REIT since the establishment of the REIT industry. So, I mean, during then, we are very well know that the REIT is meant to be a sort of retirement funds for the investors, rather the locals, Singaporeans, because we don't really seriously have something like pension fund to deal with it. Based on that kind of thinking, so I have to make sure that wherever I put in the portfolios, it actually sort of tick the boxes. It means for the retirees and means for a good kind of recurring incomes, kind of the target that we are trying to achieve. So, and for those that are very familiar with REIT, they also will understand what do we mean by three-pronged strategy. Basically, the investment, the asset management, and also the capital management. These three elements support the growth of the REIT. And of course, some can be organic, which basically the asset management will be organic growth. You do well, the asset values improve, distribution improve. That's the gist of it. If you invest well, I think likewise, you have the story of growth from that perspective. That is inorganic. I touch on the inorganic first, and then to answer your question, why we have that 3 buildings in Milan.
I think Milan is a nice city. I like it.
Does not mean it's a good property, right? So just want to understand from your point of view.
Yes. Sure. Yeah, I think the 3 asset is located at Milano Central Giulia. This is a new district and sort of like a new CBDs that we are talking about in Milan's perspective. And fortunately, our sponsor, which is Lendlease Group, is asked to be the master planner of that areas, and they wanted to build a sustainable communities, which consists of the E and the S and the G within the business district. And to that actually aligned to our goals to have a green building, a sustainable buildings, and something that lasts for the longest time. Because you need to have a green building going forward in the locations that has that kind of emphasis of a work-life balance and all those things. And that location certainly one of those that tick the boxes. And that location is also well connected with the train. Seriously, the high-speed rail and also the train that actually bring you around different places in Italy. It connect to the metros. And also, it's actually just probably 15 to 20 minutes away from the Linate airport, which also bring you around Europe's. I think that is the advantage of the locations. But again, why Milan and why these 3 properties? I think let's go down to one level down. Is how comfortable is we looking at in terms of the cash flow from these 3 properties. These 3 properties is anchored by a tenant called Sky Italia. Sky Italia basically is 100% owned by Comcast. Comcast is the number 1 in the broadcasting industry by revenue. With that, their credit ratings is actually even better than Italy as a country itself. So that provide a very comfortable kind of credibilities to us for the tenants.
In a sense, you're not worried that your tenant will default on lease payment.
Exactly. And actually, through the COVID itself, it's proven that we really make the right decision, because they never default in any of the payment. It continue to faithfully pay for the rental. At the same time, there's a rental escalation every year, and they honor that kind of escalation. They never even ask for support. That is why we actually target on this asset, and this asset itself is also having a lot of potential. It itself actually is LEED Gold certified, and because of the development of the master plan that I'm talking about, the neighborhood is also LEED certified. So this is the first in Italy. So for anyone or any tenants that look for future proving themselves to make sure that they are well covered on all the ESG requirement and all those things, they will look for buildings like us.
And I guess that also kind of picks up on a trend, especially with big MNCs where they need to do sustainability reporting, right? And scope 1, 2, 3 emissions.
Singapore is doing that.
Singapore's doing that. Europe is far ahead in terms of stringency of those requirements. So in a sense, your tenant pool might also get bigger as more and more people try to get that certification. And so, when they report, they have something nicer to say.
They have something that is well ready for them to report, and they don't know that they know that they are located in the right buildings that has no issue for that. I think the key thing that I want to actually emphasize to here is that these 3 buildings actually not owned by the sponsor. So it actually is one of the connection that we have. They're actually putting these 3 properties exclusively for us. In fact, on the day that we actually do the listing is the day when the exclusivities go to drop off. So if you are not interested in the properties, I think then we do have exclusivity, and these 3 properties will put in the market. Because of the good tenant profiles, honestly, we feel that there's no issue for us to actually acquire this building and continue to hold on to it, because it's actually as good as a AAA bonds that you hold on to it. You have that regular cash flow giving to you, and you have annual escalations that is coming from these properties. The profile of the tenant is good. You have no issue with any kind of arrears and all those things. So that is the story on why we actually acquired these 3 buildings. And now we actually have restructured the lease. The lease is actually extended all the way to 2033 with another 6 years options. So the long will itself continue to give that kind of stabilized cash flow to the unit holders. And through the restructuring, we took back 1 buildings, and we want to sort of make it multi-tenanted. And why do we want to do that? Basically, because we want to improve on the collections of the cash flow. Basically, at this moment, we are leasing at probably 60% of the market rent. We already proven that when we managed to actually lease out some of the area already from the building that we took back, and it's actually at least 50% or more higher than what we have with Sky. So
interesting.
Sorry, so when you say 60% of the market rent, is that for your new building that you have taken back, it's higher than market, is it?
Because they got single tenant.
Yeah.
Single tenant get a serious discount.
So the single tenant
Yeah.
is really low, and now because you are kind of diversifying away from them, you can find new tenants and other tenants. You are charging them a bit more.
We are charging them a bit more.
Okay.
Yeah, and
it's quite a bit more, 50%.
50%. Yeah, quite a bit more. So
Yeah.
that's the benefit of us taking that kind of restructuring.
Okay.
But of course, then on the flip side, there's a bit more risk because their credit might not be as good. Lower lease life, things like that.
Yeah.
There's always that bit of trade-off.
There a bit of trade-off, but I think we always emphasize on the right tenants to fill up the space. So we will not just simply take on any type of tenants. To be honest, we are looking at some of these big names in the market that will likely fill up the space. If you look at the whole list of the profile of the prospect that we're looking at and all fill up the space, I think it will actually, as I said, easily achieve another 50 or 60% higher than what we used to have.
Okay. And your occupancy on that particular building currently about 75%. So you still have quite a bit of room to capture in that sense.
Yeah, but it's right. What we have, right? We have gotten a 2 years indemnity rent from Sky. So that means for the next 2 years, while we're doing the leasing activities, Sky actually sort of already paid the rent for it. So in that case, we got that covered so that there's no suddenly drop in the distribution to the unit holders, as long as we complete our whole leasing activity within these 2 years.
Okay. So in a sense, when you took back that building, they paid you a bit to... It's a bit like I tenant my apartment now and I want to leave early, so I pay the landlord a bit to...
It's somehow we also actually look at the opportunities that are available. Of course, we have all right not to take back the buildings because they are leased even before the restructuring has to last all the way to 2032. And there's a break cross in 2026. That means they decided to break the lease. They can do so, but they have to give us 1 year notice. And the break cross is for 3 buildings. That means they cannot say I break 1 building, I stay with 2 buildings. But now we are giving that kind of option to them.
So in essence, it's a renegotiated termination, right? Where they can break a bit earlier, but then they pay you 2 years of rent as compensation, essentially.
Something like that.
Yeah.
Exactly.
And for you, it's a bit of a win-win as well because then you also get to lease out at a higher rate once you finish a bit of rejuvenation.
Exactly.
Like that.
Yes, that's right. That is on the Milan side of it.
Yeah.
I don't know, that gives you some color, but if you forget about all the leasing activities, just think of it is a AAA bond that you collect a good stable incomes regularly. I think that probably sort of able to sink into people's mind and all those things. So then in that case, the strategies that we have in Singapore, I mean, honestly, we're still a strong believer of Singapore asset. That's why in the whole portfolios, we have around 88% of our asset in Singapore. And the asset is quite easily accessed by our shareholders, so that in that case they know that we are doing well or they are not doing
It's
well.
easy to access, right? You walk to the mall, very crowded today, very good. All the shops are rented, very good.
Exactly. Then the question is, then why do we want to have a suburban malls? I mean, as we started off with a downtown mall initially, of course, I think the strategy is really to again emphasize on stabilized income and distribution that we want to give to the unit holders. For downtown mall, of course, it has its own attractions. I mean, it draws visitors, and it has that kind of income that actually continue to probably generate well. Let's say the whole activity gravitates into the orchard routes and all those things. But what if actually it doesn't sort of do so, and what if it actually lost its charm and all those things, right? So that's when we want to sort of like have a suburban mall. I mean, the suburban mall will continue to have its own population surrounding it, so that to sort of support the sales, support the tenants and all those things. I mean, you come to think of it, managing a retail mall is probably a more complicated asset compared to others asset, like for example, office and all those things. You only want to deal with the tenants, and other than that, nothing that you just make sure that you have a comfortable building for them, right? But for mall, it's different. The mall, you have a tripartite kind of relationship. You have to deal with the customers. You have to really provide an image for the malls. So you have to create that kind of identity, so that people with that identity draw to the mall. And then that's when you have that kind of relevant services and relevant product that's surrounding it to build up that kind of identities. So that is what we are trying to do. So for 313, we focus on young professionals, people that like to get there to experience something new, something interesting. That's why we do actually have a karaoke there. And we do actually have a bowling center. I don't know, you all know that.
I know. Upstairs. I saw Jefferson there once. Yeah, he was playing bowling.
I did
It's
not know.
It's actually not a huge mall, but we do actually have a lot of
It's
different
the
things.
old MPH, you know? MPH.
Yeah.
MPH closed
I'm
down.
dating myself a bit, but yes.
So something like that. So it has to continue sort of refine the offering to make sure that the same relevant people come to the mall. So actually, it proven that our strategy is good. Given that during the COVID, while all the foreigner cannot travel to us, we continue to achieve that kind of sales number that above pre-COVID number by, I think at this moment, we are talking about 20% more than the pre-COVID. That is when the foreign visitor hasn't even come back to Singapore. So that's why the identity is very important, so that while you very much leverage on the overseas travelers coming to you, you do actually like and you still get able to attract the locals. I think that's important. Honestly, suburban mall has its catchment, which actually be able to support that kind of footfall and sales that we are talking about. 313 as a downtown mall, you don't have that kind of continuous catchment. So how do you do that is to continue to make it interesting, so people will meet at the place, and then at the same time do more activities around the areas. That's what we are trying to do.
Yeah, fair. So and to be fair, right, I think both JEM and 313, they're quite well managed. Right? I think everybody can kind of see it, right? But the general question is still that like you said, right, running a suburban mall is very different, compared to city, or like even office versus retail is very different. And then you have another country, right? So it's like, I think what's the strategy, right? Like, what is it? Are we just searching for you, right? That means we find a good property somewhere, then it kind of meets certain things that we are familiar with, then we just buy it in, or like, yeah, because operationally very scattered. It's also quite complicated to run. There's no scale, right? So like, yeah, just where are we looking
We're
at
looking
in
at.
this? Yeah.
Yeah.
Like maybe in the next, can paint us some color line in the next 5 years, like what will be your mix? What will be your structure?
Yeah, is there a growth plan?
Yeah, is there a plan? Where are we at? That whole thing.
Yeah. We always have a plan. I mean, if let's say if not disrupted by the COVID, our momentum of growth will be even faster. That's why I emphasize on the growth of our acquisition of JEM, and then actually move us to a highest and create the records and history, all those things. These are real, and these are things that we are trying to do. And if you look at our sponsor profile and portfolios, I think you easily can sort of like amalgamate close to around 10 billion asset in Singapore. So if you want me to give you a plan of where we're going to expand, how we're going to expand, I will tell you, I will still prefer Singapore as a key locations that we are looking at. The Milan asset, I know it's a bit tricky. Why is it so, and all those things? I think to us, honestly, because of the profile of our sponsor being the master planners, and also our abilities to connect to different people, I think also the other thing that I want to emphasize is that you manage to actually have a zero tax leakage on the cash flow flowing back from Milan to Singapore. This is even better than some of the other European REITs that has European asset, but they still have tax leakage. So with that kind of structures, and with that kind of connection and with kind of exposure of our sponsor, we can grow in Europe, to be honest. Just that it is not our priorities. Because we want to align to unit holders' interests, and unit holders like Singapore asset. And we believe Singapore asset is something that we can continue to strengthen our presence in Singapore. So with that kind of 10 billion asset available, we can do so. So if you ask me my 5-year plan, our strategies, we will focus more in Singapore than overseas. So I'm also very conscious that if we were to go to some other countries, like for example, like Australia and all those, right? Yeah, I mean, people will always ask, because our parents is in Australia. So will you be going to Australia? I think the answer in the next short term might not be immediate, and we have to really have a plan for that. And also bear in mind that once you start investing in Australia, I think you have to have a mechanism or system to make sure that every of the unit holder doesn't hold more than 10% of your shares, because if not, they will be taxed on the Australia tax and kind of things. They have that kind of tax liabilities on that basis.
So there becomes a bit of a concentration risk for your unit holders.
Not really, but it's more on the tax part of it, that if let's say at this moment, all the general unit holders, they are not taxed if let's say you are Singaporean and also Singapore with a Singapore structure and all those things, right? But if let's say if you introduce Australia asset into your profile, in your portfolios, you start to make it a bit different. That means you have to have a mechanism, we call it a forfeiture trustee, that actually sort of monitor every of the unit holders that they don't hold more than 5% or more than 10% of our shares. So that in that case, they will not be triggered the Australia tax also because of our holdings.
And I guess that's more an issue for your institutional investors and your sponsor.
Yeah. It's mostly Insti and sponsor problem.
If I ever own 10%,
we wouldn't be here.
No, I will certainly treat you differently. I will bring you to Milan and visit my properties first.
So if that's the case, then it sounds like your growth plan is continued acquisition in Singapore. Is that kind of where we, or are you looking at further optimizing your assets?
Yeah, I think at this moment, it's quite punishing for any REITs that actually trying to grow with a lot of uncertainties happening around us. I think interest rate, no one knows what is the direction or where it start to actually cut. There are wars around, and there are some countries that are still reporting inflations. They are not sure how fast and how quick the interest rate cut is, and all those things are happening. So we are happy to hold on to our expansion plan. Likewise, I believe the investor are not ready to invest too. So we will not jump into it. In fact, I think at the start, we did talk about having a high gearing. So how are you going to manage it? And I did actually also emphasize that for us, actually our asset size as we do acquisition will be huge. And that's why it's not likely to continue to acquire. So my strategies, based off my 10 over years of experience in the REIT of different class and different sectors, is that for that kind of acquisition that we have done for JEM, the next thing that you need to do is to do a contractions, because you can expand. While you expand to acquire such a big giant, I think what will you be maxing up? You will maxing up your loan, because there's when it's a cheaper source of funding. So after the acquisition, you need to do a contraction, which then you need to divest something so that in the case to ease your debt profile and all those things, those to sort of facilitate you for the next positioning and all those things. So these are things that we are very conscious and mindful about. So while we hasn't executed the second part of the strategies, I think we are looking at how we can slowly sort of execute it. So expansion might not be immediate, but we need to sort of plan it in a way that we can sort of contract first, so that in that case we can we fix our gearing before we do the next acquisition.
Yeah,
So
interesting.
So there's that, I guess, a bit of a phase of consolidation.
Yes.
Right? In that sense, and I could be, I think I'm almost certainly wrong, but doesn't this feel like the wrong environment to contract? Because when you talk about capital recycling, talk about asset consolidation, you're really looking at trying to divest a bit of interest, right?
Mm-hmm.
So this feels, at least to my mind, a bit of the wrong market to do that in, or maybe just a bit of a bad timing.
I would just bad timing. I would say the market is always right if as long as you acquired your asset in the right market. So you will have a lot of activities going on. Just a matter of when is the right timing. Just like, to be honest, if let's say we were to sell our Milan asset, it's not difficult also, because I just went down probably 2 weeks ago. There's been telling me a lot of transaction has already started to come back. I mean, of course, it's not a bigger ticket items like what we have, but you're talking about 50, 100, 150 euro dollars kind of transaction is available. And before COVID, Milan is actually a very active market. Likewise in Singapore. So it's where your asset is located, because that's why it's very important when you plan your acquisition. You also have to make sure that you plan your exit. So in that case, it will not have a problem for us to execute that. So as you rightly point out, the difference is only the complication is only timing.
Okay, interesting.
But then isn't that a bit of a tricky spot, right? Because now you need to consolidate. There's a challenging market environment. But if you wait for the market to turn and then you start consolidating, then when you want to acquire,
you lose opportunity.
That's also the upswing.
Actually, no. You no need to wait for the market to turn, because as I also actually pointed out, right, why we want to target in Singapore is because we know that unit holders like Singapore asset. So as long as we can table something that unit holders like it, institutional investors support it, I think it's fine. You no need to do the contraction first, but I think the best is that you do a contraction first. So you fix it. It's easier for people to accept your next proposal. But it doesn't mean that people will not accept your next proposal of acquisitions as long as you actually have everything, I think, tick in a way. At the same time, it's accretive. I think most important is accretive. So why we want to fix the debt first or fix the gearing first is that if you were to fix the gearing, it make acquisition easier, because that will reflect on your trading price.
Yeah. I get it. Okay, so wait, from what I'm hearing, right, okay, it sounds like Milan is on the table. Right? So,
everything is on the table. You give me the right price, I sell.
So give me
a high enough price, anything can
go. Anything can go, right?
Everything can go. You give me the right price, I sell.
Okay. So you're not specifically saying we'll try to push the Milan property out and then regroup and go somewhere else. And to be fair, it also means that your JEM and 313 100% ownership is not sacred. You are willing to part of it to then
think to do so.
Okay.
Yeah. It's not actually the worst thing as a fund manager is to have clinch on to certain asset that which it actually meant to divest. So I think my team actually has been very actively looking at the disposal and hold and sell analysis to make sure that we didn't actually have some sentimental values to any of the asset. And the easier things to sort of understand whether you want to hold or sell the asset is that whether you have already maximized the value of the asset. I think, of course, to us, maximizing value is how much we can sort of like within the current structure and current framework. But to others, when they take over, they can restructure it. I mean, good for them, but we do want to spend the money to sort of restructure it. I mean, that's the thing. So every buyers or every buyer take over asset has different way to position it. That's why. But it doesn't mean that it's no good for me, it's no good for the others.
Yeah. For sure. I get it. And I think our audience, a bit more seasoned one will get it, right? You buy in an asset, you kind of structure it, and then you make it more valuable. Commercial reflects in the pricing, right?
Yes.
So then you kind of like asset enhance and you push it out into the market, something like that.
Something like that.
Fair. If that's the case, right, then if you are already looking at contracting, right? Fair, right? I think that's a fair statement, right?
Okay.
You are in a phase where you're looking at sizing better, contracting your portfolio in some ways to regroup for the next acquisition cycle, right?
Yes.
Then what about something like a Parkway, like some of these other small little things? I mean, it's not gonna move the needle, in your portfolio. You have giants like JEM, right? That is like
maybe that was supposed to be the next one.
Maybe that was
10%, 35%. Okay, 100%. It's fine.
Same strategy. Okay,
Same strategy.
So like what is the thought process there, right? Like, are we dipping in there just to test it out, or contracting and expanding, kind of, just try to give us some color.
Yes.
Yeah.
I think that definitely is a expanding story. It's just that it will not probably follow the timeline that how we do it in JEM or how we do it in probably in the first acquisitions that we have and all those things. So we definitely expanding story. It's just that whether we will execute even for the 3 phases one go, or it could probably pause for a while. So why is it a 10% stake in Parkway? Is mainly because Parkway, if you know, I think the train station has sort of already, people are start coming from the train station, and we are also doing some AEI work to make sure that it's well connected seamlessly to the entrance. So I think that part of it is what we are trying to tap onto it, and we believe that that will continue to provide that kind of growth and in terms of revenues and all those things. Again, is to provide unit holders with a kind of understanding of the portfolios. We believe that the recovery is going to be strong in terms of the MPI yield and all those things. So with that, if everything's in our favor, unit holders like it, then we will likely acquire more. But it might not be straight away acquire another 30%, another 70%, all those things. We could actually focus on other assets first, which actually provide us with more. We think that it will provide our unit holder more interest of it while we sort of hold on to our 10% of Parkway. But the interesting part of having 10% of Parkway is that unless other owners like to co-share with us, other listed owners want to co-share with us, then if not, we are sort of like put our leg
it's
one
an
foot
open
forward.
call, open call.
Yeah, our one foot forward to that asset, so that in case people know that, leave it to us to sort of slowly acquire.
But then in that sense, I understood on all of that. But is there some sort of like ROFR or right of first refusal or something to acquire more, or if you need to exit, is there some sort of mechanism?
Is there some sort of mechanics there?
Yes, I think Parkway itself is a whole in a SPV, a private fund itself. And with that private funds arrangement, certainly if let's say another investors in the fund like to divest, we will have the first refusal. And also if let's say we want to divest, I think we can also sell to the existing investors. So that is the mechanic of it. And I think that's also why we actually want to involve 10% in the asset.
So you have a bit of a control, right? No, not control over the asset, but a bit of control over the shareholdings, influence, and also could actually sort of, we want to be, being that we are the existing investor to that fund, we can even sort of drive the performance to the right directions that we think unit holder will prefer, then we acquire more.
Just to be clear on this, right? Because it sounds like when you're talking about Parkway, there is still some strategy to try to expand, leasable area, whether it's in the outside and all that, some of those things. But JEM and 313 sounds like very optimized already. Just to be clear on that, right? Are you seeing that, okay, these two are very mature already, we don't really have a lot of space to play around anymore, and this one sounds like, there's still more room to play around.
For 313, we still have unutilized plot ratios, which we can deploy. I think probably now it left around 10,000 square feet or so, somewhere around there, which of course we can deploy and we can see where is the good area to deploy it. That has yet to be sort of finalized. But as and when we see some of the tenants want to renew their leases and all those things, we also encourage them to expand some of the lettable area and all those things, which we utilize that space. So the idea is to reduce the disruptions. Of course, we can straight away roll out the 10,000 square feet, and then there will be hoarding and there will be things that sort of stop the traffic and those things, which we do want at this moment to sort of disrupt the traffic, disrupt the sales, and affect the tenants. So we sort of slowly roll it out. So there are space that we can expand and improve our distributions, but we do it in a very systematic way to preserve the cash footfall and the sales. So for JEM, we do actually have some expansion also, but JEM we have to do it in a way that we sort of cut out some space. Some of this common area, we can sort of convert it to lettable areas. But we want to make sure that once we convert, the traffic flow will not be affected and all those things. So we did something on the first floor, close to where McDonald's is, and then we do something on the basement and all those things to release some space, but not a lot.
It's not. Yeah, it
doesn't
unlikely
really
to move the
right?
needle, right? It's like
that is unlikely to move the needles.
Yeah.
But you're right. But I think what we need to do is to really continue to sort of up the rent. So if you look at our rental reversions that we have announced on third quarters, is about 15.3% rental reversion. This is quite a respectable kind of number. I think if you look at the others operators,
are we across the board or is it just JEM?
Basically the whole
portfolio.
But we try not to break it into two because we only have two assets, and it's very easy for people to sort of divide and conquer us and all. So and also to understand our listing profile. So we try not to actually break it up, but in generally it's about 15.
I hear you.
Then just to dig into that a bit deeper, right? What has driven that rental reversion? Is it that it's a bit of a post-COVID effect where rents were low, so we are going from a low base rate to something that's maybe a bit more market, a bit more on trend in terms of a longer term? Or is it that that it's just so popular that everybody wants?
Everyone is hanging out at 213. Everyone want to chill at JEM.
No, everything comes with strategies and planning for sure. I think few things we have done, and you pointed out one of the good reasons is that because during the COVID, we do actually have a lower kind of rent as a set. So in the case when you do the rental reversions for at least for this year and the next 2 years, I think we can see a very good positive rental reversion. I think the other things that has done well is our positionings and also to bring the right tenant mix that actually generate, as I told you, our sales is actually even 20% more compared to pre-COVID. So for our trade, for a retailer, what we do is that we measure something called ops cost, occupancy cost. So that means how much rent, what is their sales, what is the rental compared to the sales or the occupancy cost. So for example, the rental is $10, but their sales is $100, then the ops cost is 10%. So every trade has different absorbing point or different ops cost structure. For example, maybe F&B, their ops cost, maybe they can tolerate up to 20%, the kind of things. Maybe for fashion, they can even tolerate higher, or something, depend on whether they are the higher tier or lower tiers. So these ops costs determine how much rental they can pay, right? Because they have this bar to sort of observe, right? So if I tell you their sales number achieved by higher than 20%, so obviously the ops cost is lower now compared to what they are. So that's why we can see also we can sort of stretch the rental a bit on that basis.
Without squeezing them too much.
We have to be reasonable. That's why,
and I think that's the whole part of running a mall, right? The mall operator has to increase GMV essentially, right? Gross merchant value in the whole mall. Then you can go and talk to your tenants. Say, hey, actually, not bad.
So what we are saying is Shopify is really a shopping center.
Yeah, Shopify is a shopping center.
We have to be reasonable. I think the other thing is that fortunately, we also created during the COVID, or rather even before the COVID, we have already started off something called the Lendlease Plus app. That app itself is a royalty apps. We sort of like have this membership thing so that they can sort of redeem point. At the same time, to this platform, our tenants can also touch base with their customers. At the same time, maybe can link them to the website that they have. So this is to sort of create the kind of sales stickiness and how they sort of like leverage on us to sort of grow their business. Actually, the online sales has dropped during the COVID for around 20% to probably now back to around close to 10-ish% or even slightly lower than that. So you can see that, I mean, of course, as a Singaporean, we still like to go out and shop.
Aircon.
Yeah, exactly. Where the weather is very hot, right?
Okay, fair. So I think I have a better understanding of what's going on, because before talking to you,
Yeah, have you changed your mind?
yeah, not that I've changed my mind, but before talking to you, it does look a little bit like, what are these people doing, right? They're all over the place, right? But okay, so yeah, in closing on this discussion, essentially you're in the next phase of, your strategy is to kind of contract in some ways.
Yes.
Right?
Yes.
Yeah. So you will find the best place to sell some of these best things.
Yes.
And then get to a better gearing before you move on
That
to the
is
next phase.
very systematic way for us to sort of implement the strategy. But of course, I mean, sometimes sometimes the situation will change a bit when, as he has rightly pointed out, let's say you have acquisition that you need to buy, and then what do? You still contract or you buy or what? Then you have to make sure that even if you buy, it's receptive to the unit holders. At the same time, it's accretive. You have to be accretive so that in that case, people will support your sale.
Yeah, I think that's the basic threshold, right? Nobody will ever announce an acquisition that is not accretive.
Yeah.
Yeah, I think not for now.
If somebody told me, hey, you're a shareholder, I'm going to buy, but then I'm going to give you lower return.
Yeah.
Like,
No way.
Come on, manager.
No, but okay. So but those are normally situations, right? We're talking about the general direction. You are entering a contraction phase.
Yes, that's
right. So you will be looking at, divesting on some of these assets that you think has probably already like engineered to the max already.
Yeah.
And then redeploy some of the
Exactly.
capital in the later phase.
Yes,
Asset
that's
recycling.
Asset recycling.
Exactly.
Yeah.
Yes,
Okay.
exactly.
I'm learning a lot of new terms today.
So that's your,
good terms.
that's your
Well used.
So that's just to be very clear, and that is your story in the next
Yes.
few years to come.
Yes.
Okay. And whether it's in Milan, Singapore, does not matter. Right? Good buyer, good price, then I can.
I think it's a bit of a rational decision, right?
Yeah,
Whichever one gives me the highest return, and then I can redeploy the capital to another asset that has a higher IRR. I'm going to go for that.
You go for that. Yes.
Yeah.
It's like how we manage our own portfolio.
Yeah, it's the same.
It's the same thing.
It's
It's the same thing.
Yeah.
Yes,
Just the
yes.
size different.
Yes, of course. Maybe that's my new life goal. 10%.
10%. Yeah. Then you get all the kopi. Everything.
I get a flat in Milan.
Yeah.
And maybe that's a bit of the story, right? That it's a business that has headwinds, right? Like,
Yes.
we don't sugarcoat it.
Yes.
There
Yeah,
are headwinds.
Yes.
And some issues that you need to resolve and work through and things like that. So, and I think that has a bit been reflected, quite a lot been reflected in your share price.
Yes.
In your price to book, price to NAV, it's discounted lah.
Yes.
Not linked REIT Vet, but not great. So are there steps to address this, or is the focus really just on the business? I grow the business, I grow a strategy, and then the valuation and the pricing will take care of itself.
I think it's really a thought process that the management has to really think through what has caused the share price to sort of in this current situation. I think a few things that we feel that actually sort of been obvious to us. I think first of all, I mean, as you already pointed out, gearing is high. Although to be honest, if you look at all the REIT that actually in this commercial property
everyone is punished lah.
No, I think they are all high, right? It's just last time when people were 38, 39, 40%, we go, okay lah, there's still 5%, 10% can play with. Now you go to 39, 40%, jalat, there's only 5% to play with. There's a bit of a perspective shift as well,
on that.
right?
Yes. Yeah, I think that's one. I think the other thing is that our hedging actually is also relatively low among the rest of the REIT. So we are around 61%. So we noticed that our share price is very sensitive to the movement of the interest rate. Let's say there's a positive news of the cards and all those things, our share price reflect it also. Because why is because our unhedged portion is pegged to the the spot rate, and the spot rate is the most sensitive to the rate cut or so cut. I always tell some of these instant investors, if I were to hedge my balance 39% now, straight away I can realize a good probably 1% saving of our interest rate. So, but
Wait, net of hedging costs or?
no, because the current, for example, the spot rate is around 3.6, but the 5 years is about 3.
Okay.
So you can see that there's a difference of around 60 over basis point.
Yeah.
So if hedge everything, you have the gain already, right?
Okay.
Because you don't expose to spot, you actually go to a 5 years
Yes.
rate.
But you're plugged in, right?
You plug in.
Yeah.
Then are you sure that at the 5 year you're not going to improve better?
Yeah.
So that's why we are not going to do that. So we still sort of like continue to monitor and see what is the best position that we should be actually doing to sort of manage the interest rate environment.
Okay.
So with that, right, as a background, I believe that our exposure to the share price drop is due mainly to the interest rate situation that's going on. Why I say that is because I believe our portfolio has been performing very well. I mean, look at that. We do actually share with you that we have a positive rental reversion, right? You know that our occupancy is 100%, or even some are always been close to 100%. I think that the third thing I want to share with you is that we just managed to contract with one of the power supplier to manage to cut our electricity tariff by 30%. And then we do actually make that announcement. So in that case, that is a huge saving also. These are things that we call active asset management to sort of continue to improve the performance of the asset base while some of these macro factors that we can't sort of influence too much. So back to your valuations question. So with that, I think our valuations were whole, although the trading price did compromise, but the trading price compromise, I believe, is due to other factors than the values that we recognize of the asset in the book's values.
So in a sense, if you go back to fundamentals, the business is operating, right? Maybe a bit of headwinds, but generally the fundamentals are good. There's a lot of the macro factors that have led to increased costs, a bit more worry in the market, things like that, that concern short-term viability. But if you can get through this, and if Milan gets rented out and all of that, it actually that tailwind can become a headwind.
Yeah,
right?
exactly.
In essence.
Yeah, exactly.
Interesting.
I just feel
Sorry,
that
the headwind becomes a tailwind.
I just feel that we shouldn't be staying still. While I mean, we face a lot of challenges, struggle. I mean, that is part of life anyway, right? I mean, you can have everything's coming against you, but if you just don't do anything, I mean, end up you will be the one that actually behind. So we continue to struggle, continue to do what we can to find things that we can improve on the portfolios. At the end of the day, when the crowd is clear, I think we will stand out. I mean, it's just a matter of time, and I feel that the crowd is basically what we are talking about is the interest rate. Yeah.
Thank you for sharing.
Thank you so much.
I think you shared a lot, like quite candid. So that's cool. In closing, do you have anything you want to share with the investor? You want to like prompt them, tell them, we're good lah.
Don't worry, you'll be okay.
Anything you want to share?
No, I'm here not to really share a good story, but I will share with you what we have done. I mean, for example, we continue to be very faithfully improve the performance of the asset, drive the footfall, drive the sales, make sure we have a right trade mix, and also continue to manage the expenses. The macro environment continue to be challenging. That's everyone's been affected. But I think what we need to do is to future-proof ourselves, to create a portfolios that can still continue to stand out after everything's are cleared. And for example, we are not only fully focusing on asset performance, we are also focusing on sustainabilities. I don't know where anyone know that we are actually the first REIT that achieved net carbon zero. And we are actually probably the REIT that has the highest sustainability linked loan. Do you know what is sustainability linked loan?
Yes, a cheaper loan.
A cheaper loan.
That's all I'm interested in. Banks will take a cut.
Got hit checklist.
Yes,
then cheaper.
Bank lower margin, very good. I like.
Exactly. We are actually we are the REIT that actually has the highest of this. So all this is to position ourselves that everything's go away, all the headwinds go away. We are able to stand tall. I think that's what we are trying to do. So I mean, if you want to understand more about our REITs, I think we are happy to sort of see how we can engage with you guys more. But at this moment, we feel that there are headwinds, and the headwinds is quite obvious to us. Is probably it likely will be only the interest rate.
Okay, nice. Thank you.
Thank you.
All the best.
Thank you.
Thank you so
All
much.
right,
Thank you. Thank
I
you.
hope you acquire Parkway 100%. I like Parkway. Thank you.
Thank you so
for
much.
your
Thank
time.
you. Thank you.
Awesome.